Welcome to The Explainer. Today, we're diving into something that's honestly a bit of a mind bender. We're going to unpack how U.S. economic decisions act as a giant master control room for global liquidity. And, more importantly, we're going to figure out exactly what that means for your own hard earned investments. Let's get right into it. So, before we go any further, I want you to just stop and think about something for a second. Are your local stocks, your mutual funds, actually being secretly steered by macroeconomic decisions made thousands of miles away in Washington, D.C.? I know, it sounds a little out there, maybe even a bit provocative, but the data tells a truly fascinating story about how totally interconnected our global financial system really is. Okay, here's our quick roadmap for today. We'll hit part 1, the global economic engine. Part 2, Fed rates and global liquidity. 3, the dollar index. 4, sector sensitivity and tariffs. And finally, part 5, the diversified investor playbook. Starting off with section 1, the global economic engine. So looking at the big picture for 2025, we're seeing moderate global expansion across the board. You've got the IMF projecting 2.8%, the World Bank at 2.7%, and the OECD slightly higher at 3.1%. But the real story here isn't just reciting these numbers. It's how incredibly tied these forecasts are to U.S. trade policies and domestic demand. Think of the U.S. economy like the lead car in a high-speed train. When it shifts gears, the rest of the world absolutely feels the acceleration, or, the brakes. Moving on to section 2, Fed rates and global liquidity. The U.S. Federal Reserve literally controls the tap of global capital. Heading into 2026, the U.S. Fed rate is sitting right around 3.5 to 3.75%. Now, why does that matter to you? Well, it narrows the yield gap, what traders call the carry trade, with India's RBI rate, which is at 5.25%. Here's the kicker. That shrinking gap directly influences whether foreign portfolio investors decide to keep their money in emerging markets or pack up and bolt for the safety of U.S. shores. Money always goes where it's treated best, right? But actually, why those rates go up matters just as much as the fact that they do. The World Bank brilliantly breaks this down into two distinct scenarios. First, you have a reaction shock. This is when a hawkish Fed aggressively hikes rates just to fight inflation. It's a defensive move, and it unfortunately causes massive global capital flight. On the flip side, you have a real shock. This is driven by actual genuine U.S. economic growth. A real shock is vastly safer and can even be positive for emerging markets because it's fueled by a hungry U.S. economy demanding more imports. The data paints a really stark picture of this. When you have those defensive reaction shocks, they aggressively depress capital flows and equity prices in emerging markets. It's a heavy hit. But a real economic shock, the impact is surprisingly benign. It's a great reminder that in global finance, context isn't just something, it's absolutely everything. All right, section 3, the dollar index, or DXY. If you aren't familiar, the DXY basically tracks the US dollar against a basket of 6 major developed market currencies. And here's the wild part. Even though this index completely ignores the Indian rupee and all other emerging market currencies, it is, without a doubt, the single most important macroeconomic indicator global traders watch. It's the ultimate global scoreboard. Think of the DXY and emerging market assets like they're on opposite ends of a playground seesaw. When the dollar index spikes, say it pushes above 104 or 106, foreign institutional investors pull their money out fast. This puts a ton of pressure on local assets. The rupee weakens, gold prices tumble, and the Nifty 50 generally takes a beating. It's just a direct, brutal chain reaction. Let's dive into section 4, sector sensitivity and tariffs. 100%. That massive number represents the absolutely staggering U.S. tariff implemented in October 2025 on branded and patented pharmaceutical products. This was a massive policy move aimed directly at forcing domestic U.S. manufacturing and cutting reliance on foreign suppliers. A real game changer. But hey, if you're an Indian pharma investor, before you hit the panic button, consider this. A massive 85 to 90% of Indian pharma exports to the U.S. are actually generic medicines. And here's the good news. Generics provide this incredibly thick safety net because they're completely excluded from this specific tariff. It just goes to show why digging into the actual makeup of exports is so critical. In fact, if we trace India's export history to the US over the last 20 years, we've seen a dramatic structural shift. We've largely moved away from those traditional, basic goods and heavily toward knowledge-intensive sectors. Today, those knowledge sectors are absolutely dominating the trade relationship. Just look at IT services. Their share of U.S. exports has skyrocketed from about 14% to over 38%. And ironically, this sector is actually a brilliant partial hedge against all this macroeconomic turbulence we've been talking about. Why? Because Indian IT companies earn in strong U.S. dollars, but they spend in local rupees. This means they actively benefit when a strong DXY depreciates the local currency. It's like a built-in shock absorber for your portfolio. Let's wrap things up with section 5, the diversified investor playbook. So, knowing all this, how do we handle this intense global interconnectedness? The number one takeaway from the data is diversification. You literally have to have a strategic mix. We're talking about favoring short to intermediate bonds to dodge some of that rate sensitivity, targeting high-quality value or dividend equities, and making sure you're using real assets like gold or REITs to hedge against unpredictable geopolitical shocks. You can't just put all your eggs in one basket anymore. And please, remember this absolutely crucial point. Yes, the US controls the massive levers of global liquidity, but a fundamentally strong domestic business can still thrive, even when the global macroeconomic weather gets incredibly rough. If a company has a great business model and robust local demand, it essentially creates its own kind of immunity. So while you're keeping an eye on the macro, never lose sight of the micro. Don't overreact to the global noise if the local fundamentals are rock solid. So I want to leave you with this final provocative thought. Knowing exactly how closely tied your local investments are to the US dollar and interest rates, is your portfolio truly diversified enough to handle the next big shift on the global control panel? It's something we all need to be asking ourselves. Thank you so much for joining me on this explainer. Keep learning, stay curious, and I hope this helps you navigate the markets just a little bit smarter and with a whole lot more confidence.